I'm James Helliwell, and today I sit down with Koku Agbo-Blow. Amidst the back and forth of speculation, we have three more great topics from you this week, with a particular focus on commodities, the inflation debate, and the battle of wits between the market and the Fed. So what brilliant interview that was with Russell. I think that the key takeaways, for me at least, were how he's completely overhauled his framework, having had something of an epiphany around 2016, how it shifted away from focusing on macro and the business cycle as the primary driver of assets to instead focusing on politics. So in terms of how he's looking to play it, he's focusing on real assets such as gold and other commodities, particularly the food names, and being short long-duration bonds. It's often in the earnings calls, the transcripts which you can read, which are really, really interesting to people like me, maybe not to you.
Not to me, but to you,
Really interesting. And the reason I get excited about it is not just on the numbers side, but you get sort of insights into the textual stuff about whether or not they might be planning to make cost reductions or lay people off. Commodities tend to move in the opposite direction to the greenback. And what's more, inflation is the inverse of dollar momentum with a lag. In other words, the most important signal in global macro is pointing to disinflation ahead. Now, there could be a bunch of other things that I could contribute here, whether it be a sharp decline in leading indicators of the housing sector and business activity, the slowdown in Europe and Asia, or accelerating trends in technology and industrial automation, with robotics displacing labour. But honestly, even this isn't enough to persuade me that inflation won't remain a problem until cracks appear in the labour market and that wage spiral is brought under control. Whenever the level of core CPI has exceeded 5%, as we see currently, the Fed funds rate has needed to exceed it in order to bring inflation back towards target. With the Fed funds at 3.25% today and core inflation at 6.6%, there could be room for considerable tightening still to come. Could it be that perhaps this time is different and we don't see any deterioration in the jobs market despite a recession? Or perhaps that the Fed pulls off the economic miracle of a soft landing, bringing inflation under control without triggering a recession at all? As the previous three hiking cycles peaked, the Fed held rates for 7 months before the first cut in year 2000, 13 months before the first cut in 2007, and for 6 months before they pivoted in 2019. So if the Fed goes another 50 basis points at their next meeting, which it hasn't ruled out, and then perhaps another 1 or 2 hikes of 25 basis points to catch up to core CPI, assuming that remains around a similar level, then we're potentially looking at 2 to 3 months before the earliest pause, and, based on recent history, at least 6 months of rates being held from there. So the base case is that the Fed will continue hiking until consumers rein in their spending and businesses scale back production and look to reduce costs with hiring freezes and job cuts, thereby reducing wage inflation. With the unemployment rate at cycle lows and the level of initial jobless claims barely above 200,000, the transmission of higher rates might well take a bit longer before the full brunt is felt for employers and workers. As more electric vehicles are produced in response to secular trends, the demand for those raw materials that I mentioned earlier should also see a multiplier effect. But before we get ahead of ourselves, it's worth considering some of the demographic shifts that might be a drag on growth in the coming years. And speaking from my experience in building composite models for the business cycle to guide asset allocation, I find that fundamentals work best in identifying areas to de-risk towards the peak of the cycle, but ultimately price rules in the recovery. And from my experience, this is one of the best indicators for signal versus noise. In fact, since 1970, the year-over-year change in the LEI index has a 100% hit rate in anticipating recessions following 2 consecutive months below zero. Here you can see the relationship between the year-over-year change in China's imports and the price of crude oil. The idea being that crude oil is an essential input in the production of pretty much everything. So as China consumes more goods, the demand for the commodity also increases, thus driving prices higher. And here's the correlation that crude oil typically has with CPI. After all, the stock market is a leading indicator of earnings in its own right, and it shows improvement before the actual economy does. And here's one of my favourites, the ISM, but specifically the prices paid sub-index. As you can see, it tends to provide a reliable lead on the direction of US CPI, with the two being positively correlated.
But amidst all of this, we want to ensure that we don't lose sight of some of the big secular opportunities that do still exist out there.